I have been an investor for the last 10 years but never made money. As soon as I exit, the market starts going higher. But for the period I remained invested, it never went up. Only my stocks don't go up. I have so many friends and they talk about so many companies that have delivered great returns for them. I feel that the stock market is manipulated by operators and retail investors can never make money. Interest rates going higher, inflation going higher, there is a war-like situation. How can I continue to be an investor? It is very risky to be an investor during such time. Don't worry. If what all I just said is disturbing you as an investor, don't worry. In today's masterclass, we will get you the right answers for all these questions and share a formula that will not only make you a stress-free investor, but it will ensure that you start enjoying the wealth creation journey. You are watching Informed Investor, an initiative by Research and Ranking. Let's begin. Formula to Success. This is the title we have given to today's masterclass. And by the time we finish this episode, you will know why this title has been given to this episode. We'll start with Nifty 50 index performance. Here, we have given 20 years data, FY 2002 to FY 2022. As you can see here, it's not a straight line. There are periods when Nifty has delivered as high as 89%, 78%, 51%, 49% return in a given year. But then there are certainly periods when it has delivered minus 10%, 8%, 5%, 26%, as high as 41% return in a year. Now, as an investor, the starting point we follow or we intend to follow that I should make money every year. Looking at this chart, it's not very difficult to understand that may not be the reality. In a given year, if index itself goes down by 8%, 9%, 26%, 41%, certain little bit of outperformance is expected. Against 8% minus, 4% minus is possible. Even flat is possible. But if a year like 2008 comes or a year like 2020 comes, then it is very difficult. Minus 26% or minus 41% can certainly not become positive for any investor. Then there are periods with very low performance, 0.38%, 8%, 7%. Now in such years, if there's some bit of outperformance, 10-12% is possible. If there's some underperformance, it could even go down to 2-3%, 4%, 5%. So instead of doing it too much on a yearly basis, what a successful investor would do, he'll do it, he'll look at a return over a 5-year or a 10-year basis. As you can see over here, 20 years CAGR comes 13.95%, which is a very healthy number, 13.95%. But this 13.95%, as I said, is not a sequential growth line. Now, if this is about index, we can certainly look at sectors. These are the top 10 performing sectors, and this data is by market capitalization. Again, as you can see here, the range is from 10% to 23%. This is by market capitalization. So FMCG as a sector has delivered the highest return or has gone in terms of market capitalization the highest. CAGR comes 23% for almost 17 years. For the other sectors, chemical, BFSI, realty, it is as good as 20-odd%. For certain other sectors, telecom, energy, it is low, 10-12%. Now, As we saw in case of Nifty, it was not a straight growth line or sequential growth line. FMCG is the highest performing sector, 23% in terms of market capitalization. But you see, there are 4 5 years block here, 3 5 years block and 1 2 year block. In the first block, as you can see, it is 35%, almost 35%. The next block, 2011 to 2015, it is 26%. The third block, 2016 to 20, if we normalize the return, if we remove the fall that happened in March 2020, then it is 11%. Otherwise, 9.65%. The last 2 years, 21 and 22, have been highest performing year, 25% for those 2 years. And the average for 17 years comes 23.16%. And same is the case with most other sectors, almost all the performing sectors. This one, 25% in the first block, 23%, 13%. And last 2 years, 21 and 22, 34%. And for 17 years, average comes 22%. We can keep looking at the other sectors and the story will not change. In case of BFSI, it is 34%, 14%, 6%, 21 and 22, those 2 years as high as 47.58%. And for the 17 years, average comes, CAGR comes 21.15%. For the other sectors which have not performed as high as 20% or that have not seen a period of high growth, we can look at sectors like this, capital goods. First block of 5 years, 40.96%. Next block of 5 years, CAGR market capitalization growth, 1.71%. The third block, minus 9%. Even if we normalize, it comes minus 2.35%. But look at the growth in last 2 years, 72.41%. Overall for 17 years, the CAGR comes 15%. Telecom, CAGR comes 12%. Energy, look at the growth in 21 and 22. Despite that, CAGR comes only 10%. Look at this slide, sector rotation over last 20 years. As you can see, same sectors in terms of market capitalization. Again, I am repeating in terms of market capitalization. Don't remain in the same sequence. BFSI was at number 3 spot in 2005, was at number 5 spot in 2010, and third spot in 2015, and in 2022, it is right at the top in terms of market capitalization. Then comes IT, FMCG, healthcare. These 4 sectors, 20.88%, 13.61%, 7%, 5%. And if we add the other 2, which is auto and auto ancillary, paints and chemical, between these 6 sectors, the contribution is as high as 50%. Out of 2,64,000 crore total market capitalization, contribution of these 5 sectors or 6 sectors comes close to 50%. But these sectors, as we know, as we have looked at here, they were not there right at the top in 2010 or in 2005 or in 2001. BFSI was not there in the list and the market capitalization was only 6 lakh crore then. In 2005, it was as small as 17 lakh crore. 2010 was 61.65 lakh crore. 2015, 101 lakh crore. The point I am trying to make here, market is growing, market capitalization is growing. Year on year, market is growing, capitalization is growing. Capitalization is growing for 2 reasons. There is certainly growth in the businesses and there are new companies. New companies getting listed, not every year, but there are few periods in between when there's no new IPOs. But then there comes a period like last year, 21-22, there were too many IPOs. So we had almost 2,300 or in that range about 15-17 years back. Currently we have more than 5,000 listed companies. So number from 2,300 has grown to more than 5,000. So even that adds to market capitalization. But apart from that, sectors, companies, they are growing. They are growing. So instead of bothering too much about what happened in a given year, if I started my journey in 2018 or 2019 or 2020 and I didn't make too much money, that's fine. That's fine. As we can see here, 20 years data or 21 years data from 6 lakh crore to 264 lakh crore. Almost 44 times jump in market capitalization. Somebody asked me a question a few days back, how much should I invest in equity? If I have 100 rupees, how much should I invest in equity? And my simple answer was, investable surplus that you can keep aside for minimum 5 years. Longer the better. Minimum 5 years. During those 5 years, there will certainly be a year when you will make, let's say, 10%. There could be a year when you will make minus 5%. But what we just saw, then there comes a year when one can expect to make even 50%, 70%, 80%. In year 2021, April 22, March 21, people made as high as 100%. That 100% cannot be a normal year. Right? One cannot expect 100% return coming every year. Right? And how you get that 100%? Only if you continue to be there. If in a year when market does, let's say, minus 5%, as an investor you lose 2% or 4% higher, which is, let's say, minus 9%, or 4% lower, minus 1%. Because you have lost money, you feel demotivated and you decide to exit the market. Right? If we have a negative performance year or two negative performance year or low performance year, plus 5% and plus 10%, or plus 10% and minus 2%, then it becomes very difficult to stay invested. And that's the mistake most people make, most investors make. Why? Because they don't look at 20 years data. They don't understand the fact that from 6 lakh crore to 264 lakh crore, 44 times jump has come in last 20 years. And sector rotation is certainly important. Certainly important. It is important to understand which are the best performing sectors, contributing the most in overall market capitalization, and one can certainly try to do it this way, that I have little higher allocation in those sectors. In any case, if out of total 264 lakh crore, 21% is for this particular sector, BFSI, I cannot have less than 20% weightage in my portfolio. It could be 25%, 30%, right? Even 35%. So this is equally important. Understanding which sectors are performing is equally important. Rotation is equally important. But exit is not the formula to success, right? This is now we can look at not in terms of market capitalization, but different indices, how they have performed over last 17 years, 2005 till 2022. Nifty Bank CAGR comes 12.4%. Nifty Financial Services CAGR comes 18.4%. Nifty IT comes 15%. FMCG here is 13%. There we looked at FMCG sector, it was the highest performing sector in terms of market capitalization. But sector has performed over last, and this index was not there in 2005. Hence, the data is updated starting 2011. Then there are certain other sectors, they have not done as good. Reality, although in 2021, it was one amongst the best performing sector, both realty and metal. Both realty and metal. But if we look at again 15 years data, or here we have updated since 2011, 11 years data, then except these couple of years in between, 2017, 2021, there is hardly any year when this sector has outperformed other sector, or this index has outperformed other indices. Nifty metal again couple of years, 59%, 28% are there, but overall CAGR if you look at comes 4.6%. In case of reality it comes minus 4.3%. So it is important to understand sector rotation, as I said. It is important to understand. One must invest in the sector during 2017, 2021. But is it possible to do it as precisely that I will enter my allocation towards the sector, I will increase it to 10%, 12%, 15% in 2017, and next year I will reduce it to 0. It is not possible. It is not possible. Hence, 15 years data, 20 years data, long period data. This gives you a clear understanding that, okay, there will be a period in between when this index or this sector will outperform all other indices, all other sectors. But not always. Not always. The second mistake we make as an investor, if in a given year, a particular sector is outperforming or performance has been really high, we try to allocate the maximum to that sector without looking at 15 years, 20 years, 10 years, long period data. We are also saying it is important to invest in all the sectors, especially in such sectors, realty, metal, during years like 2017 or 2021. But two things, it cannot be done so precisely that one can time it this way that I will allocate the maximum to these two sectors whenever the time is right for the sector. And second, even if you have entered, it is difficult to know that next year is not going to be a very good year. So sector rotation is important, but at the same time, one must know looking at 15-year, 20-year chart is little more important. Little more important. And if there are sectors which are contributing as high as 50% in market capitalization, top 6 sectors we just looked at, anybody has to invest 50% or in that range in those 6 sectors. That's how one must do it. And if there comes a period when a particular sector, although it has been the highest performing sector and the long-term average for that sector is the highest, but it is not doing as well, little bit of churning or rebalancing is fine, but not too much. Just because in a given year, sector has not done very well, companies in that sector not done very well, one cannot reduce the allocation or should not reduce the allocation to a very low number and increase the allocation for the other sectors which are although not very structural growth sectors, but because they have outperformed the other sectors in a given period, one must not increase the allocation to a very high number. So understanding the 20-year or 15-year chart becomes very, very important. Becomes very, very important. Understanding the fact it will never be a sequential growth line becomes very, very important. Whether it is Nifty or it is different sectors, including the most performing sectors, it will never be a sequential growth line. Now, since we have looked at Nifty and we've looked at sectors, look at certain companies and good performing companies. Good performing companies. Here we have companies that have delivered minimum 7 times returns in last 10 years. And I'm saying minimum 7 times. As high as 73 times is also there in last 10 years. But same story. Bajaj Finance 73 times in 10 years. But look at the periods in between. In last 4 years alone, this company has corrected at least 30% or in that range at least 4 times. At least 30% or more than 30%, 62% is also there, but that's due to COVID, so I'm not really counting that one. 62%, it was, as we know, because of COVID. But the other three falls, 32%, 22%, 30%, are also very steep fall. Look at this one, APL Apollo, 57% fall, 46%, 15% and 28%. Look at the other one, 43 times in 10 years, but same story. 36%, 18%, 37%, 30%, 41 times in 10 years, same story. At least 4 times in last 5 years. All these companies have corrected by 20% or more, even 30%, 40%, as high as 60%. 10 years performance is certainly more than 10 times. For all these businesses is more than 10 times. But in between there are periods of correction or underperformance. Look at this. Minimum 3 times return in last 5 years. The other set of companies. Minimum 3 times in last 5 years. 4 times, 5 times, even 17 times is there. But it's not a sequential growth line. 17 times in 5 years, but 2 times it has corrected 37% and 35%. Avenue Supermart, most of the investors know about this company, and it has delivered great upside. In 5 years, 5 times. 31%, 28%, 17%, even 39% in the recent fall. This company, after that it has gone up by almost 20% in last 1 month or so. But yes, there was a period in between when this company from the high very recently corrected as high as 40%. Although 5 times in 5 years. 5 times in 5 years, but look at the recent fall, 44%. From 905 to 502, 44%. 4 times in 5 years. Look at the falls, 16%, 37%, 16%, 17%. Now this is the data for companies that have delivered minimum 100% return in last 2 years. This company has delivered as high as 7 times in 2 years. 7 times in 2 years. 18% fall, 29% fall very recently. Triveni Engineering, 40% fall very recently. Before that 21%, 24%. Tata Power, so many people wanted to invest in this company in last 1 year, 1.5 years. So many people. Why? Because 143 to 257, almost 100% return came in 1 month or less than a month. 6 times returns in 2 years. Actually, it was not 2 years, it was 1.5 years. If you see the starting point, May 2020, when this stock was trading at 36, 37 rupees to 257 in October 2021, almost 7 times in 1.5 years. 7 times in 1.5 years. But if I show you 5-year chart or 10-year chart for this company, you will not be so amazed. People who invested in Tata Power 10 years back, even they have not made this kind of upside. Hence I said, there comes a period or a year or 2 years when an underperforming sector outperforms all other sectors. A company like this 7 times in 1.5 years becomes possible. But you certainly can't jump in with 20% capital allocation, 10% capital allocation. And it is certainly not possible to time it this way. That I'll start investing in this given company in May 2020 and I'll exit after 1.5 years or 2 years. 6 times I'll make in 2 years. Not possible. Century Ply, 5 times in 2 years. Dixon, 4 times in 2 years. This stock has also corrected, not as much, but 18% and 15.56% at least 2 times in last 2 years. This is the last block. More than 50% returns in last 1 year. Tata Elxsi, most of the investors know about it and most of the investors wanted to own this stock. Some people, it's possible, some people may have not been able to do it because in that sense it's a difficult company to understand. When I say difficult, the kind of projects they have, the kind of business model they have, at times it becomes difficult to do the projections for next couple of years. But still, this company has performed 124% in 1 year, and in that 1 year, at least 3 times more than 10% fall was there. Very recently, the fall was as deep as 24.35%. CRISIL, almost 88% return in 1 year. Indian Hotels, 139 to 235, 79% return in 1 year. Same story. If you had invested in this company even 5 years back, you would have made more or less the same amount. So this was a 100 rupees stock in that range few years back, and even a year back it was in that range. So 79% in 1 year because of high consumption. Again, sector rotation. VIP Industries. This stock has been a wealth creator, but look at the falls. 19%, 12%, 27% in 1 year. I am not showing you 2 years data, but this company went down to as low as 200 rupees or 220 in that range. That fall was very, very steep for this company at least. More than 60% or in that range. But even in last 1 year, although 60% return, but 3 times 19%, 12%, 27% fall is there. Why I'm showing you all these data points, this is the interesting slide. Now we have looked at Nifty or the index, we have looked at different sectors, and we have looked at the performing companies, right? And it was not a sequential growth. It was not a sequential growth. Here, we have given Nifty CAGR, top sector CAGR, top company CAGR for 21 years. And as an investor, we want it to look something like this: 100 to 1200, 100 to 1800, and 100 to 2700. What is this? If I had invested 100 rupees in top sectors about 20 years back, that 100 would have been worth so much today. 27 times, 18 times, even Nifty 12 times or more than 12 times. But the lines will not look like this. We have looked at Nifty, performing sectors, performing companies, we have looked at. And this is the data for 21 years for the companies that have outperformed the Nifty or the sectors. We've looked at so many such companies, performing ones in last 5 years, 10 years, 2 years, 1 year. But as I said, the problem doesn't end here. There's more to it. We have so many AMCs, mutual fund schemes as we call them, asset management companies, and they run so many mutual fund schemes. So 44 AMCs, active schemes currently are about 665. We have so many research analysts, registered research analyst 861, registered investment advisory 1329, total SEBI registered active stockbrokers 314. Then we have stock market influencers 9,300 plus. We have business news channels, Hindi and English 12, and obviously there are other news channels in other regional languages. We have financial newspapers 9, and we have investment marketplaces, small case, wealth desk, Trinker, and so on and so forth. Why I'm showing you all these data points? As I said, even if you have understood as an investor that Nifty growth, sector growth, company growth will never be a sequential growth line, and if by understanding so much one wants to believe I have understood everything and now I'll be able to invest the right way, that may not be the case. That may not be the case. Because I have the tendency to check what others are doing. I'll certainly come across so many people or so many stockbrokers or investment advisors or research analysts, market influencers. And I'll be tempted to do something, because if one of my friends says I had joined XYZ broker or investment advisor and I happen to make this kind of upside, which is more than what let's say you had made as an investor in last year. you'll be tempted to do something with that stockbroker or with that investment advisor. If there is a market influencer and there is a video which has 20 million plus views, whatever is recorded in that video, you'll certainly consider it during your investment journey. And I'm not saying don't do that, don't do your research, don't do your homework, who all are there, who all investment advisors are there, or brokers are there, or influencers are there. I'm not saying don't do that. You can certainly do that. But you must ask this question to yourself more than a few times: how much is too much? And how many are too many? How much is too much and how many are too many? Because there's plenty. 1,000 investment advisors, 800 research analysts, 300 brokers, almost 10,000 influencers, so many newspapers, so many news channels. So even if you have understood the concept, it will not be a sequential growth line, but till that time you don't ask this question to yourself, how much is too much or how many are too many, it will become difficult. It will become difficult because then there will be another stock advisor or broker or influencer, and again you will feel tempted to do something more. And if this was not enough, we have so many WhatsApp groups, Telegram groups, our colleagues, friends, relatives. Over and above, stock brokers and advisors and analysts and influencers, we have all of them. They are also guiding us in good faith. I'm not saying they are charging money. Most cases they are not charging anything, and they certainly don't want you to not to do well. All right. But ask yourself, how much is too much? Or how many are too many? Now, as an investor, we always have reasons to believe why the current time is not a good time to invest in markets. Always. It's written over there in all capital letters. And current time is with an underline, right? Here is the list of current worries. And this list, by the way, keeps changing. Hence, current time was with an underline. Current worries are inflation going up, interest rates going up, continuous FII selling, geopolitical issues, fear of recession. This is the current list of worries. Now look at inflation data. Again, I've shared some bit of data with you, and I'll share a little more, because without data, true picture cannot be understood, or the big picture cannot be understood, right? 20 years inflation, long-term average comes 6.31% long-term average. 2022, it was 6.73%. April 2022, for 1 month alone, it was 7.8%. In between, it was as high as 10.88%, 11.99%. But this doesn't tell you the whole story. If we look at only inflation data, if I tell you India GDP growth, and I have covered this extensively in my Elite Club speech. Please do watch that video as well. India GDP growth for 20 years comes close to 12.4% for 20 years. Last year, which is 21-22, was as high as 19.4%. This year, 22-23, as per the current estimates, should be in the range of 13 to 14%. 7.2% real growth, 6.7% inflation for this given year, 22-23. We are a country that has been growing at 12% for so many years. 12% for so many years. Inflation average comes 6%, which is half of the growth rate. So you can certainly not expect that in a country like India, inflation will be 2%, 3%. That is possible for a developed economy. In between, when low growth years come, let's say overall as a GDP, we don't grow 12%, but we grow only 8%, 9%, 10%, right? And those are the years given here, 2017 to 2020, when the overall economy grew 8-9%, 10% in that range. And hence the inflation was also as low as 3-4%. So in our country, in our economy, inflation is growth led or demand led. If we have to continue growing at 12% plus to become a 5 trillion economy or a 10 trillion economy, inflation will remain little elevated. Then the second worry is interest rates going up. Now this is the repo rate movements over last 21 years, as high as 8.5%, and the current rate, even after yesterday's increase, comes 4.9%. Even after yesterday's increase, 4.9%. Inflation we just looked at, it was 6.73% for FY 2022, and for April 2022, just for 1 month, it was 7.8%. If inflation is in the range of 7%, how can interest rates be in the range of 4%? It was 4%. In between, couple of years, the interest rates were as low as 4%. We just looked at even inflation was in the range of 4%. And there is a direct correlation. Because if inflation remains 6-7%, interest rate remains 4%, 5%, it's a negative interest rate cycle. Then essentially what I'm saying, for something, I'm paying 7 rupees more, right? There was a laptop I bought for 10,000 rupees last year, and now after 7% increase, the cost is 10,700 rupees. But 10,000 rupees I deposited in bank or in any fixed income instrument, and that has grown to only 10,500, only 5% increase, right? So on my purchase, I am supposed to pay 700 rupees higher, but on my money or on my investment, I am making only 500 rupees, which is to 2% in a way. It's I'm paying from my pocket. My money is not growing even at that pace. How is it possible? If inflation is in the range of 7%, interest rate will certainly go higher. And it's a transitory period. We know what happened in 2020-21 and last year for that matter, 21-22. So in between, for good 4-5 months, there was no demand, there was no consumption. April 22, September 20, I would say. But at the same time, people continued earning money. In other countries, in developed economies, people had access to a lot of free money. I'll cover that as well. So if demand, there's a pent-up demand situation. There was a pent-up demand situation in October 20 to, I would say, March 2022. For that 1.5 year, almost 18 months, right? So during such period, inflation is bound to go up. And with inflation, don't forget, in our case, at least in our case, country is also growing 12% plus. And this inflation is transitory in nature. Even, RBI governor yesterday, the forecast he has given is going to go down. Inflation is going to go down. It will not remain in this range for the remaining, year. It will not remain in this range. Interest rates is still might go up because there is still room. Another 50 basis point is possible. So inflation should be in the range of 5.5-6%. And this I am saying not this year but next year. And interest rates will also be in that range, 5.5% or in that range. So don't worry too much about it. There are economists, doing their job, right? Bankers doing their job. Smart people than you and I doing their job. Trust them. Now, the next one is Fii outflows. Again, it's a big worry. For most investors, it's a big worry, right? There are news coming every day that FIIs have withdrawn so much, 2 lakh crore, more than 2 lakh crore they have withdrawn. But just look at how much they own. So they own more than 50 lakh crore. Out of 264 lakh crore, they own about 20% of that. 52 lakh crore. 20% of 264 lakh crore. We just looked at the market capitalization as on 31st March 2022. Out of 52 lakh crore in FY 2022 and in the current year, put together, they have sold about 2 lakh crore. In this given year, FY 23, they have sold only 50,000 crore. The stock's worth 50,000 crore. But just look at, again, 20 years data or more than 20 years data, how much have they pumped in last so many years? Year on year. And they have increased their shareholding, by the way. Overall, market capitalization, they used to own 15%, which they increased to, as I said, almost 20% as on 31st March 2022. From 15% to 20%. They increased. FI shareholding has increased that much. Right? And out of 52 lakh crore as on 31st March 2022, they have sold only 50,000 crore. 1% of the total. And this is just 2 months. Just 2 months. Right? But at the same time, we have net equity fund inflows. DIIs as we call them. They are investing. Mutual funds are investing. Normal investor, SIP inflows. Just look at monthly figures. They are investing. So it certainly cannot be a reason to worry that FIIs have withdrawn so much. 50,000 crore out of 52 lakh crore. 1%. Cannot be a reason to worry, at least as of now. Interest rates are rising in developed economies, and during such time, it happens. It happened even earlier. But India is a structural growth story, 12% plus growth year on year. No investor can exit India completely. Not possible. There is no other country in the world. There is no other country in the world. Again, I have covered, we will become a 5 trillion, even 10 trillion economy. It's anybody's guess whether it will be in 27 or 28, 1 or 2 years could be here and there. But that was the event we did about 10 days back. India will certainly be a 5 trillion economy few years down the line. And a 10 trillion economy, let's say in about 10 years or 12 years from now. Growing at 12% or in that range year on year for next 10, 12 years. So how can any investor, big or small, right, Indian or a foreigner, can exit? Not possible. This is little bit about geopolitical issues, a war-like situation. I mean, it has happened so many times in the past. So many times. If you look at this, it's not clearly visible. But so many times, starting like, you can start with September 11 attack, 2001. Right? At least 7, 8 are there after that. An extreme right column, just look at 1 year return after the event or after the incident. It is always positive, right? And such geopolitical issues, I mean, or crisis like situations, maybe, I mean, if you look at this after 5 years or after 10 years, few more will be there on this list. People like you and I can't do much about it, right? In last 15 years, 20 years, so many are there. What can we do about it? And certainly not a reason to worry, because if the growth is there, then it in a way gives you an opportunity to buy good business at a lower rate. This is how one can make use of it, as long as growth is there. And in our country, as we discussed, growth has always been there for last so many years. Now this is the last worry, and because it's there in news almost on a daily basis that US going into recession and growth rate going down, especially in developed economies. We have presented 8 quarters data here. Quarter 1 2020 till quarter 1 2022, 9 quarters. Now you look at its US GDP data, and US GDP size is almost 23-24 trillion dollar. $23-24 trillion. For such an economy, it's not possible to grow at 34%. Look at Q3 2020. Before Q3, Q2, the economy was down by 31%. So this is something extraordinary, and we know why, because of COVID, right? There was so much money that they had printed, so much free money that was given to citizens or to support the livelihood, that after that, even Q1 2021, Q2 2021, it has been very high growth periods, very high growth periods. Even 6% growth is not possible. In case of US, the GDP growth used to be in the range of 2-3% and inflation 2-3%. I have shared an example in my Elite Club speech. In the interest of time, I am not doing that again. Please listen to that example, and you will understand why this is not a reason to worry. 2-3% real growth, 2-3% inflation makes it 6-6.5%. Now, because in the current time, and for the reasons we have already discussed in Elite Club speech, inflation itself has become 7-8%. If inflation itself has become 7-8%, minus 1.4% we have here Q1 2022, which means growth has still been in that range of 6.5%, which it used to be. Before COVID, it used to be in that range 6.5% or 6 to 7%. 2-3% inflation, 2-4% growth, as I said. Inflation used to be only 2-3%. Now it has become 7%, and hence we have minus 1.4%. And next year, if they again have one more quarter of negative growth, 2 consecutive quarters of negative growth termed as recession. So don't be worried. Don't be worried. This inflation is transitory in nature. Don't be worried. Now let's look at this, where we started from. As an investor, our starting point for most of the investors, the starting point was 20-30% growth year on year. Whenever they started, that will continue to be an investor for 10 years, 20 years, will make in that range of 20% to 30% year on year, and it will be a smooth wealth creation process. That's day one, where we usually end up 50 stocks, 100 stocks, even 200 stocks portfolio. CAGR, in most cases, either not known or negative CAGR. We have a few investment advisors, few colleagues, few brokers who are advising us, and a few influencers. And it doesn't remain a stress-free process. It becomes a stressful process. A stressful process without any real gain. Without any real gain. But it doesn't have to be this way. If what I covered in last half an hour, 45 minutes, if we have understood the true meaning of everything that I said, it doesn't have to be this way. We can certainly look at 5-year, 10-year, 15-year data and understand, okay, if I really want to be an investor, I have to give it at least 10 years, 15 years, minimum 5 years. All years will not be the same. And I cannot have 50, 20, 10 influencers, advisors, brokers, colleagues telling me what to do. Because there are sectors that have outperformed, underperformed. There are companies, although they have delivered even 50 times. But even such companies do correct 30, 40, 50%. So how can I become a successful investor, a stress-free successful investor, only if I know it will never be a sequential growth line. It will never be a sequential growth line. There will be periods of ups and downs. I will lose money. In a given year, I will lose money. But in a country like India, growing at 12% plus for so many years, I'll take that as an opportunity. I'll not be worried about it. I'll not confuse myself. That although last year was a negative growth year for me, should I worry, should I exit? And that's what people do. People make this mistake. Optimism, is the starting point. Then excitement, thrill, euphoria, complacency, anxiety, denial, fear, panic, anger. And anger is the exit point. After that, depression, hope, relief and optimism. So most people exit the market when they are angry. Why they are angry? Because last 1 year didn't make any money. Last 2 years didn't make much money. It has grown but not very handsomely. That's that anger point, depression point. But that's the point which most investors who have been successful, they take it as the entry point. Not that they can time it or anybody can time it, but they know, and you can again go back to Nifty chart, after 1 or 2 years of underperformance or negative performance or suboptimal performance, the third year or fourth year will always be a very high growth year. You can go back to Nifty chart and check it. 1 year of negative performance, 1 year of suboptimal performance, look at the third year or fourth year. And hence I said minimum 5 years average. 7 years even better, 10 years even better, minimum 5 years average. We understood this problem a while ago and we have come up with a solution for the larger set of investors. Our key focus areas. Listen to me very carefully. Because if you could understand this in true sense, then whatever I have discussed in last 1 hour, you will be able to understand how to come out of that situation. If you understood this part. Stay away from the 6 financial diseases. So there are 6 we have mentioned: leverage or borrowed capital, price is everything, no time to read, news all the time, over diversification and under diversification, excessive churning. It's very important to understand these are 6 financial diseases. Price is everything. We looked at performing companies, good performing companies, 10 times in 5 years, 50 times in 10 years. But there also we saw 20%, 30%, 40% drop in a matter of couple of months. Just imagine if you exit those businesses just looking at price performance, would that be a right decision? No. No time to read, news all the time. What we do as an investor, normal investor, for news we have all the time, but for reading we have no time. And hence we make this mistake. Because if I don't know anything about the business, or I don't know that much about the business, but I certainly know about geopolitical issues, FII selling, interest rates rising, inflation rising, right? I'm certainly aware about all these headlines, but don't know much about my business. So in that sense, they are all linked to each other. Over diversification and under diversification. We looked at so many brokers, so many investment advisors, so many influencers, friends, colleagues, WhatsApp groups. And once we have a few more to buy and a few more to buy and a few more to buy, leverage or borrowed capital becomes a reality. Excessive churning becomes a reality. Because I always have 2 more to buy and 2 or 5 or 3 to sell. It is not possible to have so much liquidity available all the time. So borrowed capital becomes a norm. Excessive churning becomes a norm. Please, please, please understand these are the 6 financial diseases. The second focus area talks about not all years are alike. We looked at it. Nifty, sectors, companies, we looked at everything. Nifty delivered as high as 70-80% in a given year and minus 5%. So many sectors. Realty, capital goods. We looked at metal. 1 year, 50%, 70%, even 100% growth. But 11-12 years CAGR we looked at was hardly anything. In case of reality, it was minus, right? Not all years are alike. For markets, for sectors, for companies, not all years are alike. Successful investors treat every crisis as an opportunity. We just looked at that as well. Anger, depression, that's the point. Where a normal investor would say, okay, enough is enough, now I am not going to continue my journey. Last 2 years or 1 year, I didn't make much money and I am exiting. That's the point where good businesses are available at a bargain price. Third focus area, in the short run, markets are driven by sentiments and liquidity, and in the long run by fundamentals. In 1 month, March 2020, 12,000 to 7,500. Almost 40% drop in a month. There was so much of fear. So much of fear. And in the subsequent months, there was so much of liquidity. There was so much of liquidity. April 20 to June 21, for more than a year, there was so much of liquidity. Now is the time when markets are looking at fundamentals. In the long run, markets are driven by fundamentals. So in 21-22, markets, in a way now running as per fundamentals, growing or degrowing as per fundamentals. Very closely monitoring what is the EPS growth for a different for various sectors or companies or overall market. But 2021, nobody was doing that. For two reasons. First, as I said, there was too much of liquidity, and probably it was not possible to predict that what the EPS growth or degrowth could be. But in the short run, it is possible, not in the long run. In the long run, only fundamentals prevail. And hence, if there is a good business and it has corrected 20, 30, 40, 50%, one must take advantage of it, because if the business growth, underlying growth is intact, that correction is an opportunity. We'll come to that as well. Fourth focus area, you always own and cherish a few. Too many are a crowd to manage, right? If I have 2 brokers, 2 investment advisors, 2 registered analysts, I have a subscription with, 10 influencers I follow, 5 colleagues are expert, how can one become a successful investor? Not possible. Not possible. It will become a crowd. It will become a crowd. First focus area, we just looked at 6 financial diseases. Over diversification, under diversification. More than under, over diversification becomes a problem. Excessive churning. You will always have a few to buy, few to sell. Where is the wealth creation in this? Where is the wealth creation in this? What should we do to avoid such problems and ensure that we don't miss the big picture? Certainly, data, knowledge, education should be given more respect. News, rumors, only price action should not be given respect. Right? Now, the last part of this episode, and the most important one, I would say, you can call it a research framework, or you can call it, in general, any investor, these are the 7 most relevant parameters to see before investing in any company. If you have little bit of understanding, I'm not saying you have to be an expert. Little bit understanding, revenue growth, volume growth, profitability growth, little bit understanding. Debt levels, to ensure that the growth should not be debt induced. Return on capital employed, at least 15% or more should be. Longevity, competitive moat in the sector. Promoter holdings in the company to ensure promoters' skin in the game. Reasonable institutional holding by strategic investors, targeting high growth sectors and emerging themes. And here we have covered why all these 7 points are relevant. We have divided those 7 points into 3 categories: growth, quality of growth, and growth outlook. Now imagine if there is an industry growing at 20% or more than 20%, right? Certainly companies in that industry are likely to do better than other companies, right? Companies with growth mindset. Ab industry is a growing industry. There are a lot of opportunities, but you must know how to take advantage of that. And we have looked at so many examples in so many sectors. Not all the companies did equally well. Not all the companies, and you go to any sector, I'll not mention a few examples because that may confuse you, but just do this exercise. If there was any industry, banks or NBFC or paint or any industry, auto or any industry, just write down all the players. The canvas was the same, at least at the starting point. At the starting point. But because of growth mindset, certain companies did very well, and the other companies in the same sector couldn't do as good, right? Durable moat. Growth without moat ends soon. Moat without growth underperforms. So moat has to be there and longevity has to be there. If I know that my business can continue growing at this pace for 10 years, 20 years, then only it can become a wealth creation story. Then only it can become a wealth creation story. In between, there will be a period when you buy a few businesses. People tried doing that last year. We just looked at realty, metal, all these sectors, although they have not done well if you look at 10-year, 15-year data. But last year it was a very good year for certain sectors, including capital goods. So either you do it that way, but that timing can never be perfect. And you certainly cannot allocate a very high percentage to such a sector. So what one has to rely on, companies with good growth prospects, leverage, cash is king, free cash flow, very important, low debt, again very important. And by the way, these are two different things. Free cash flow doesn't mean company has not taken any debt. It is possible company has taken debt and even vice versa. It's true. Could be true. Return on capital, as we just discussed, very important. Capital deployed and return generated on that. This is before interest, before tax. Should be in that 15% or little higher is even better. Promoter holding, skin in the game, business confidence indicator. I mean, if you know there is a promoter always buying, or at least has the intention to buy, you can be a little more confident on the business. You can be certainly more confident on the business. Institutional holding, because they have access to little more data, or they know little more about the business, a little more. So if there is a company where okay, institutional investors are continuously increasing stake, then one can be a little more confident. Now these 7 parameters, if we rate the businesses we looked at in different buckets, 10 years, 7 times, 3 times in 5 years, minimum 3 times, double in 2 years, and 50% in 1 year, we just see PAT CAGR for, and we have taken one business from each bucket. Just an example, we have taken one business from each bucket. 33%, 37% PAT CAGR for 10 years. In case of Century and VIP, it is not 10 years, it is in case of Century 2 years, and in case of VIP, 168% is for 1 year. Growth for 1 year. Debt is very low. ROCE, in case of Bajaj Finance, is not relevant. In that case, it should be return on assets, ROA. Any number to more than 2% is a very good, a very healthy number. It is 3.28%. And 20%, 19.75%, 23% for other businesses. Promoter holding, again, more than 50%. Institutional holding, again, more than 10-15%. We can't imagine a situation that a business delivered 5 times or in that range in last 5 years, 10 years, 3 years, but there was no PAT growth. We can't imagine. There cannot be a situation. There can certainly be a period a business delivered 500% in 6 months. But then we know how those businesses are, how those companies are, and how they go down in next 6 months. So-called penny stocks. But that is not investing. We are discussing real investing here. So in case of real investing, it is not possible. If a business has delivered 10 times, 5 times, it has to deliver good PAT CAGR. It has to have good ROC, free cash flow, very low debt level, good promoter holding, good institutional holding. These are the parameters, not very difficult to understand. And again, I am giving due respect to sector rotation. Right? But as an investor, even if I know this much, and sector rotation, risk diversification, risk management, I can leave all that for my advisor. Still, I would call it a good beginning, very good beginning. One can always educate, himself more, how different sectors have performed and how much allocation I have to each sector, right? Even that exercise, if one wants to do it, why not? How the risk diversification works, how the rebalancing works, why not? Do that. No problem. If you want to educate yourself more and more, no problem. But in the process, don't add 50, 100, 200 stocks in the portfolio. Sector rotation, risk diversification, risk management, everything is possible only if one has anything between 20 to 30 stocks in the portfolio. More than 30, more than 40, more than 50, it becomes a crowd to manage, as I said. But these 7 parameters, along with these 7 parameters, sector allocation, 8th one, risk diversification, how much to allocate to each business, 9th parameter, and risk management, which is rebalancing at the right time, not price driven. But yes, if there is a situation like last year and metal is going to do very well, then some allocation from some other sector I remove and add or allocate to metal or to capital goods or to realty is fine. So such rotation or rebalancing. Beyond these 10 points, only thing one needs to do, and say formula to success, what I said in the beginning. The only thing beyond these 10 points one needs to do, look at this presentation at least a couple of times and understand it will never be a sequential growth line. For Nifty, for sectors, for companies, it will never be a sequential growth line. Right? Please do understand and appreciate there are thousands of brokers and advisors and analysts and influencers, and probably all of them are doing a wonderful job. All of them. But just be with 1 or 2 of them. Whoever, if you see, if you believe that, so and so person or company is doing a good job and I want to be with him, again, as we just discussed, too many stocks, a crowd to manage. Likewise, too many associations become a crowd to manage. And there is a reason why I am doing this masterclass today. In the event, I happen to meet some of our clients and I realized they are making this mistake. They are making the same mistake. They are making the same mistake by allocating 80% to one stock. 100 rupees portfolio and 80% to one company. 5 influencers, 10 sub-brokers, 5 SIPs, 5-6 subscriptions with different investment advisors. I happen to meet some of our clients who are making the same mistake. And there is an objective, there is a purpose, as I said. It's for them, it's for everybody, but especially for such clients or we have in our system, it's for them mainly. This masterclass is for them mainly. Please don't make such mistakes. If you happen to be one of them, please don't make such mistakes. Whatever you do, please have this end objective in mind. 13-14% Nifty return, 6-7% over and above Nifty, 8%, 10% if I take advantage of a crisis like situation of whenever there is a fall in the market. That makes it to 20 odd percent or anything between 20 to 25%. That much year on year, and again I am repeating, minimum 5 years, minimum. 7 years, 10 years, even better. India is a structural growth story, so no problem, it will happen. It will happen. But we have looked at it will not be a sequential growth line. So this episode is for everybody, but especially for those who are making all these mistakes. Please don't make, because that will never allow you to become a successful investor in the long run. There is only one formula to success. First, understand the true meaning of 4 focus area, and then these 10 points. 7 points company related, we have discussed in detail, and 3 points industry allocation, sector risk diversification and risk management. Formula to success. Once you have understood 4 focus area and these 10 points, it's short formula to success. Short formula to success. And when I say formula to success, 20 to 25% CAGR over 10 years. Over 10 years. It was possible between 2012 to 2022, and it is certainly possible from here on for next 10 years. In between, whatever, if there is an underperforming sector, outperforming sector, underperforming companies, outperforming company, no problem. No problem. There will be other incidents, other events, no problem. No problem. You can't control everything, na. In last 10 years, 15 years, 20 years, we can't control anything. And still GDP grew 12% plus. Our GDP grew 12% plus. Nifty 13.95% CAGR. There were so many problems, so many challenges, so many events. Certainly there could be. No, there could be even 5 years, 10 years down the line, there could be certain other events. But as long as 12% growth is there, which is most likely going to be there for the next 10 years, 20 odd percent year on year growth is possible or thereabout, if one takes advantage of any crisis like situation. So more on this when we hear from you. If there is any question, any query, any clarification required, you can certainly write in the comment box. We'll reach out to you. In certain cases, if possible, I'll talk to you personally. But please educate others. First, educate yourself, and then we would certainly expect, you don't have to tell them join R&R. If they don't wish to do it, no problem. It is not, certainly it is not a marketing exercise. It's coming from my desk, it is not a marketing exercise. Please educate yourself and educate others, because this is the formula to success. If anybody not doing it this way, 1 year, 2 year, anything is possible, but 20% plus CAGR or 25% plus CAGR is certainly not going to be possible for 10 years, 20 years. So please educate as many as you can. Thank you.